Hi friends, this is not a clickbait video. The reason I am creating this video is because in the last 2 to 3 weeks, a lot of experts and economists have started to speak about high possibility of US recession coming in 2025. For example, a recent survey done by CNBC where 95% of CFOs in US have said that it is extremely hard to make business decisions because of policies that US government is implementing right now. Trump's policies are chaotic, they are disruptive, and these are extreme policies for businesses to navigate effectively. And it's not just about the CFO saying these things, it's also about what the other economists, the fund managers, have been saying. For example, in a recent CNBC Fed survey, it has been highlighted that US economy is slowing down. US GDP growth has started to come down. Again, I'll present you a lot of data about GDP itself, but the point remains that are there macroeconomic indicators which are telling us, which are screaming out and telling us that there is a high possibility of US recession in 2025. In this video, I'm going to cover 3 hypercritical points. Point number 1 is why do you need to care about recession? And I'm going to present to you some mind-boggling data about last 3 recessions and how they have impacted Indian investors. Point number 2 is that I'm going to break down 4 US specific macro factors that you must know and they're screaming out in terms of the possibility of US recession. And point number 3 will be how to go about preparing ourselves in case there is a US recession in 2025. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. If you want to learn investing practically, you can consider joining my YouTube community. The feedback of this community has been excellent. I speak about diverse assets almost on daily basis. You're going to learn a lot practically. With that, let's get this video cracking. Let's start with first point, which is why should you care about recession? So for this, I have done analysis of last 3 recessions in the US and how that have massively impacted investors. I'm going to present you some mind-boggling data. Allow me 2 minutes of time. Have a look at my screen. You will see that the last recession we saw was between February 2020 and end of March 2020. The recession only lasted for 2 months. But have a look at what happened to Indian stock market. We all know that during this period, which was the COVID recession, Indian stock market fell by almost 38% within 2 months of time period. Now you may say that, Rahul, what is the big deal about this 38% of fall? Because you only tell us that in terms of the long-term investing, these falls do not matter. Markets eventually recover. I 100% agree with that argument. But one thing that you need to know is that after 2 months of recession, it took almost 8 months for Indian stock market to recover back. This total 10 months of painful period is what investors had to go through. And mind you, this period was completely uncertain. Nobody really told these investors that it is going to take 10 months and everything will be fine. They were sitting with uncertainty. They were biting their nails. They were losing sleep because their portfolio were down by almost 38%. It was gradually increasing, but nobody really told them that it is going to be fine for the 10 months. I mean, look at what happened in the month of September 2024 to February 2025, when recently Indian stock market started to correct. When Nifty was down by 18%, there was a big chaos. A lot of people actually left stock market. My point is very, very simple that these recession events are extremely important from a wealth perspective. Therefore, we need to understand about these. Let me now move to recession prior to COVID, which was from the period of December 2007 to June 2009, which lasted for 18 months of recession period. Now, this was much longer. That's why I'm talking about it. And Indian stock market during this 18-month period fell down and found the bottom at 60%, almost 59.46% of down was Nifty at that time, and this was mind-boggling. It was such a long duration of 18 months of market continuously coming down, and guess what? The recovery took even longer. 21 months of recovery time period when the stock market went back to its original levels before the recession had hit. So if you put 18 months plus 21 months, almost 3 years of time period where a lot of people's portfolio was in red for continuously 3 years of time period. And the third and the last recession that I want to quickly cover is from March 2001 to November 2001, almost 9 months of period. Dot-com bubble bust happened. Nifty was down by almost 40% during that time period. But mind you, at that time, Nifty was already down before the recession had hit. So it doesn't matter where Nifty is. Whenever US goes into recession, Indian stock market take a big beating. That's what the past is telling. In this particular recession 3, you will note that it took almost 2 years for market to recover and go back to their previous highs. So almost again 3 years of painful period. What I really want to do is tell you the exact situations right now so that you can prepare for it. I'm not saying that recession is confirmed, it is likely to come, 100% chances are there. No. I'm not saying that. All I'm saying is that you need to be aware of these data points and understand where is US economy going right now. If I were to ask you to track only one thing right now from a macro perspective, that has to be the possibility of US recession. Having said that, let me now present to you 4 macro factors that are screaming out right now and giving us some signals about the US recession. The first macro that I want to speak about is the GDP data of US economy. And the reason I'm speaking about the GDP data is that all of us know that the technical definition of recession is that if the GDP of US has declined or contracted for 2 consecutive quarters, we technically say that we are in a recession. So if you look at the last 2 quarters GDP growth data for US economy, you will see that actually US economy has not contracted. In Q4 of 2024, which is ending in the month of December 2024, GDP grew by 2.3%. Prior to that in Q3, GDP grew by 3.1%. So from Q3 to Q4, we can see that the growth has been slowed down, but it is not a negative GDP growth per se. But the biggest problem with GDP as a macro data is that it is a lagging indicator. Why it is a lagging indicator? Because it will only tell you about recession when something has happened in the past, which is that in the last 2 quarters, if the GDP has contracted, then only it will tell you that you are in recession. And by then, from an investor's perspective, it's too late. We are already in the recession. Therefore, there is a limitation of using GDP as a lagging indicator. So the question comes, what could be a better indicator? So I want you to understand about a concept called GDP now, which is a very, very similar model to the official GDP data. But the difference here is that it is called GDP now, meaning it is telling you the GDP right now, right? It is not telling you the GDP from the past perspective. It is telling you what is the GDP as of now, as on date. But please understand that this is calculated by Federal Reserve Bank of Atlanta. It is not an official data point as such. So you cannot really take it as a face value or official data point. But this is a very, very important data point that can tell us a lot about what is happening in the US economy right now. So if you look at this data estimate on March 28th, 2020-25, as per this GDP now model, US economy has contracted or have shown degrowth, and it is come down by almost 2.8%. And as you can see in the month of March here, there is a sharp drop in the GDP growth data here. In fact, GDP has declined as per this data point. And guess what has happened in the month of March? Trump's tariff has started to take effect. There was 25% tariff in the Mexico and Canada, 10% on China, and a lot of American businesses started to prepare for these in the month of February. And as all of us know, countries like Mexico, Canada, and China retaliated. They also imposed tariffs back to US. So there is an argument here that US companies that were exporting to Mexico, Canada, and China might have seen some impact in their businesses. And maybe that is what has caused this contraction in the GDP in the Q1 of 2025. Now you may say that, Rahul, how accurate is this GDP now data? So if you look at the past forecast of GDP now, there has been an absolute error of around 0.77 percentage point. Again, my point is very, very simple here, that it doesn't really matter whether GDP declined by 2.8% or 2%. What really matters is that likelihood is that in Q1 of 2025, US economy has contracted. Now, when it comes to the official data point, we will only come to know about it in the month of April and month of May, because first estimate will come out at the end of April, second estimate by the end of May, and third estimate by the end of June. And by the time, it's too late for investors to know that what happened in Q1 of 2025. Right now, using the GDP now data, we are able to see that there is definitely a slowdown in US economy in Q1 2025. Whether this slowdown will continue or not, it really depends on, again, what is going to happen in tariffs in the month of April, May, and June, and so on. Let me now move to second macro factor, which is the most important, which is the yield curve or inverted yield curve. Now, please do not worry about it. I will give you the simplest possible explanation of yield curve and inverted yield curve, and more importantly, how it impacts the recession, right? Have a look at my screen and you will see on the y-axis something called as yield. Yield is the net return you get from investing in bonds. So for example, here 2% yield, 3% yield, 4% yield, 5% yield. You can think yield as the net effective return you're getting from investing in a bond. On the x-axis, you will see the different maturity or the time period of a bond. So for example, 5-year bond, 10-year bond, 15-year bond. So what you see on this chart is 3 possible scenarios. Scenario number 1 is you see the green line, which is the flat yield curve. What does this simply mean? That it does not matter what is the duration or the maturity period of a bond, whether it's a 5-year, 10-year, 15-year, 20-year, your yield is at 3% constant. This is a flat yield curve. It doesn't really happen in the economy, but this is one example or a scenario. Now comes the second scenario, which is the blue line here, which is the normal yield curve, which is this is going upwards. What does this simply mean? This is showing you that the economy right now is very, very healthy. There are no danger signs. Why I say that? Because here the short-term bond, let's say 5-year bond is giving you only 2% yield versus 30-year bond is giving you 5% yield. Now, what does this simply mean? That 30-year bond is giving you 5% yield. It means the yield is high. And when the yield is high, it simply means the price of the bond is low. And this is because for a bond's yield to be high, let's say 5%, their price needs to be low. Then only you are going to buy it at low price and make a lot of profits. Therefore, bond yield and the price goes inverse in terms of a relationship. Now, what happens if the yield is high? It means the bond prices are low. What does the bond prices low actually signify? It signifies that bond investors are not buying this particular bond. There is very little demand for this bond. That's why the price is low, that there are no buyers in the market. What does this tell you? That bond investors are not buying the long-term bonds. They're in fact buying short-term bonds. Why? Because in short term, they see that economy is fine. There is no issue. If I buy a bond for 2 years or 3 years, I know government is not going to fail. I'm going to get my money back. Therefore, they have lot of confidence in the government because of this normal graph. This is what the normal graph is telling us. Now comes the deadly inverted yield curve, which is the red line, which is coming downwards. What does this simply mean? This simply means the reverse of normal yield curve. Red curve is telling us that there is a stress in the economy right now because people are not buying the short-term bonds. They are buying the long-term bonds. As you can see, the yield of long-term bonds is lower. It means the price is higher. It means the demand is very, very high for long-term bonds. The demand of the short-term bonds is not there. It is telling you less confidence in the US economy right now. Okay, this was a lot of explanation, but I hope the concept is clear. If it is not clear, please watch this one more time or read a bit more about the yield curve. You will understand the basics of yield curve. But now comes the million-dollar question. Why am I speaking about the yield curve? Because if you look at the past data, so if you go back to US history up until 1980s, what you will note is that before every recession, so you see here 5 recessions, one here in COVID, then you see this financial collapse in 2007-8, then you see dot-com bubble. Before these recessions, what you see is that yield curve inverted. So what you see here is, for example, yield curve inverted here, yield curve inverted here, yield curve inverted here. So there is a pattern here that before every recession in US, there was inversion of the yield curve. Also, please understand that it doesn't mean that whenever a yield curve has inverted, there has been a recession. So it's not other way around. It's that whenever a recession has happened, prior to the recession, there has been inversion of the yield curve. And guess what is happening right now in 2025, 2024? That's what we are seeing. Yield curve is inverting here. And there is a likelihood of US recession following us. How likely that will be, whether we will be able to avoid it, whether there is going to be a soft landing, is only future can tell you or God can tell you. I am giving you these data points. I am teaching you these macroeconomics absolutely at zero cost. And if you're liking this content, the only request I have is like this video. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Now you may wonder and ask me that, Rahul, why is it that right now investors have less confidence in the short-term bonds? And this brings me to my macro factor number 3, which is the US fiscal strength. Have a look at my screen and you will see US debt position right now. In 2024, the debt has gone to 1.83 trillion US dollars. It's been going up steadily from 2022 to 2023 and then 2024. Now, what's the big deal about the debt going up? So whenever the debt of a government goes up, what is likely to happen? They are going to need money to be able to repay interest on this huge debt. That goes up, the interest payments goes out. Where is government going to get this money from? Either they can print more notes, right? If they do that, inflation goes high. Secondly, they may impose more taxes on the people of America. And guess what happens when the taxes are imposed on people? They're likely to stop spending money because they will not have money to spend. And when that happens, what happens? The economy slows down because the consumption goes down. So these are some of the correlations that you can learn about. But right now, the fiscal position of US is looking weak. It is not looking strong in my view. And in fact, what happened in the last few days is that Moody came out warning again about US fiscal strength. People who are not aware of the controversial announcement that was done by Moody back in November 2023, where Moody had assigned a negative outlook to America's top-notch AAA credit rating, there is definitely a problem when it comes to the US debt, and that is also playing into sentiments of the investors. That's why they're keeping away from the short-term bonds, they're going for the long-term bonds. Moving on to fourth macro factor, which is unemployment rate in US. Have a look at my screen. You will see that whenever there has been a recession in US, for example in COVID, unemployment rate shot up to almost 14% here. Back in 2007, 8, 9, it shot up to around 10%. Right now, if you look at the unemployment data, it is slightly going up, but not at very elevated level. It is around 3.8 to 4.1% right now. So there is no immediate concern on the unemployment data. But what is happening right now is also we need to understand Trump has been laying off the federal workers in US. You might have heard about these layoffs that has been happening, and more importantly, you might have heard about DOGE, which is the Department of Government Efficiency led by Elon Musk, and apparently he has put a potential cut of more than 100,000 jobs across 2.3 million member federal civilian workforce. So the point is very, very simple. Trump is laying off federal workers in US, and that may cause unemployment in the coming weeks and months. And that is definitely one thing that we need to watch out for in the next coming weeks and months. Also, there have been announcements like this where Trump administration cancels $12 billion in funding to state health departments. This news just came out on March 27th, and these are going to have big dents in terms of the federal spending. Therefore, unemployment in US may go up in the next coming weeks and months. We need to be really watchful here. So all in all, looking at these four macros, what are the chances of US recession in 2025? If you look at the Fed survey, the likelihood of US recession is 36%. It has gone up from the previous forecast of 23%, if I remember that correctly. Again, I'm not saying here that there is going to be 100% US recession in 2025, but the chances have gone up. And this analysis hopefully would made you aware, more educated about what is happening in the US economy. Now the billion-dollar question is, what can we do as investors to protect ourselves from this US recession? Let me spend 2 to 3 minutes on this now. So when it comes to what are the strategies that Indian investors should adopt, number one is that diversify. I've spoken about diversification a lot in a lot of my videos. Please make sure you have a part of your portfolio into fixed income instruments. For example, fixed deposit, for example, bonds. In fact, on bonds, I recently created a full video speaking about how to go about getting 11%, 10% sort of a yield on bonds. That video is still there. Make sure you learn about bond investing as well. But diversification remains the key. Please make sure you have some of your exposure in fixed income instruments, be it FD, bonds, etc. Point number two is that throughout 2025, please make sure you are building some cash positions all time. Minimum is around 15 to 20% of cash you need to have all the time. And depending on how the US economy does, depending on how the Indian economy is doing, depending on how the markets are moving, you might need to take this cash position up to maybe 30%, 40%, and even 50%, because this will be really handy in case a US recession hits us, in case Indian stock market falls. You can go and look at buying the dip, and I'm talking about the dips here like 30% fall, 40% fall, not 10%, 5% of the falls. I'm talking about some significant falls, and the best friend for you at that time will be the cash that you have, not at 5%, 10%. This is all about 30%, 40% of buying the dip. The third thing is really be cautious on IT services, because all of us know companies like TCS, Infosys, Coforge, HCL, they have 70%, 60% of their revenues coming from US market. Please make sure that you are reviewing your IT positions very regularly throughout 2025. Right now, if I speak about the IT PE ratio, it is at 28.5. If you look at the 5-year PE range, it is at around 29. So one could argue that it is fairly valued, but if you're talking about recession, you got to look at the low PEs, the 5-year low PEs at around 15. That is what you need to keep in mind when it comes to IT investing in 2025. Fourth point is also have a look at the exports that we do to US. For example, have a look at my dashboard and you will see, for example, engineering goods, electronic goods. So basically EMS sector has got heavy export exposure. Therefore, stocks that are in EMS sector, you really need to be careful about. Another sector that you need to be really careful is pharma, because again, drugs and pharmaceuticals is 11.47% exposure. And then you go and look at companies like Cipla, Dr. Reddy, you will see that they are all fall down by 20%, 30%, 40% because of these fears as well, mainly reciprocal tariff threats as well as possibility of US recession. Again, I'm not saying that go away and sell all your stocks in the pharma sector. No, that's not the intent. But please make sure you're factoring in the risk of US recession into your buying. My point number 5 and last point, which is investing in US market itself. If you look at my screen, you will see that in the last 2 years or so, Nasdaq, for example, have given almost 96% of rally. In the last 2 to 3 weeks, you see that it is corrected by almost 14%. In my view, US market is overdue for some deep correction. Again, I'm not trying to speculate here, but that's what my sense is telling. I am really not buying anything in US market right now. I'll wait and watch and see how US economy is playing out in the next few weeks and months. Only think about taking positions if I think the valuations are very, very good. There has been a deeper correction. That will make sense. So I've covered a lot of grounds in this video, and if you want to learn these things practically, you can consider joining my YouTube member community. I speak almost on a daily basis and the feedback of this community has been great. You're going to learn a lot practically from me as well as from the community members. With that, I hope you enjoyed this video. If you did, press the like button. Let me know in the comments a simple thank you. I will see you in my next video. Until then, keep rocking.